What if I told you that right now, while everyone is celebrating market highs and calling this a golden age, there's a pattern forming in the shadows that hasn't appeared in 95 years, not since the months before the world descended into the greatest economic collapse in history? A pattern so precise, so undeniable, that every single time it has emerged without exception, what followed wasn't just a downturn, it was a complete restructuring of everything we thought we understood about wealth. The yield curve has just triggered something extraordinary, something that in 1929 gave us exactly 18 months warning before 80% of market value vanished and a quarter of all workers lost their jobs. And if you look closely at what's happening right now, that same 18-month clock has already started ticking. The question is, are you listening? Now, I know what you're thinking. Yield curve sounds like jargon invented to keep regular people out of the conversation. But here's the truth. This is one of the clearest indicators we have of what's actually happening beneath the financial surface. Think of it as a fear gauge measured through the price of time itself. On one side, short-term rates, what borrowing costs for a few months. On the other, long-term rates, what investors demand to lend for many years. Normally, the curve slopes upward. Lenders want more compensation the further out they go because the future holds more uncertainty. That's rational. That's healthy. That's how functioning credit markets work. But watch what happens when the system senses danger before anyone admits it publicly. When institutional money starts moving towards safety while headlines claim everything's fine, the curve inverts. Short-term borrowing suddenly costs more than long-term lending. Think about that backwards logic. Investors would rather lock capital away for a decade than lend it for 6 months. They're saying, we don't trust the immediate future, but we'll survive if we can just outlast what's coming. And history has shown us, without exception, that whenever this inversion appears, every recession, every financial breakdown that followed was already set in motion. The yield curve doesn't predict crashes. It reveals them before they're visible to the public eye. Let me walk you through exactly what I mean. Go back with me to April 1928. 15 months before the world would experience economic devastation on a scale never seen before or since. The inversion showed up then, quiet as smoke. Most analysts missed it completely. The few who noticed it dismissed it as a statistical anomaly, nothing to worry about. But it was screaming that credit had become untethered from reality, that speculation had replaced sound lending, that the party was about to end violently. And what happened? The market ignored the warning entirely. Stocks didn't fall, they surged. Almost 50% gains after the inversion signal flashed. Every newspaper, every financial column, every broker on Wall Street called it the beginning of permanent prosperity. Investors felt invincible. The economy seemed unstoppable. Then October 1929 arrived. Within weeks, 80% of market value was erased. 1 in 4 workers, 25% unemployment. The wealthiest nation on earth descended into breadlines and shanty towns. The Roaring Twenties didn't fade. They were obliterated overnight. And that inversion? It wasn't luck. It wasn't coincidence. It was the financial system's early warning that the foundation was already crumbling, even while everyone danced on the surface. Now watch as we move forward through time, because this pattern doesn't just repeat, it haunts us across generations. 1969, the curve inverts, and 5 months later, recession hits. 1973, it inverts again, right as OPEC weaponizes oil and energy prices explode, shattering consumer spending power overnight. The economy contracts, unemployment climbs, gas stations run dry, and Americans sit in hours-long lines just to fill their tanks. 1979, another inversion, another economic slide. 1981, rates spike so high that businesses can't borrow, households can't spend, and the economy grinds to a halt under the weight of debt service costs. Every single time, the sequence is identical. Inversion first, economic collapse second. But here's where it gets deeply unsettling. The inversion doesn't always trigger immediate disaster. Sometimes there's a lag, a deceptive period of calm that convinces people the danger was overblown, that maybe this time the old rules don't apply. Look at 2006. The curve inverted well before housing prices peaked. For over 12 months afterward, markets kept climbing. Housing seemed invincible. Unemployment sat near historic lows. Every financial commentator on television declared that the yield curve had finally lost its predictive power in the modern economy. Then 2008 came, and the global financial system nearly collapsed entirely, triggering the worst crisis since, you guessed it, 1929. The inversion didn't fail. It simply gave us advance notice while we chose to ignore it. And here we are again, standing in that same haunting space between alarm and impact. August 2022, the yield curve inverted, sending its clear signal that systemic stress was building. The market's response? It rallied. The economy didn't weaken, it appeared to strengthen. Unemployment stayed near record lows. Consumer spending remained strong. Tech stocks, especially anything AI related, became the next speculative fever. Everyone pointed to the data. See, this time is different. Let me tell you about those 4 words. This time is different are the most expensive words in finance, not because they're always wrong, but because they only appear at one specific moment, right before the pattern completes itself exactly as it always has. If you're finding value here, hit like and subscribe. This breakdown won't come from mainstream outlets, and you'll want to catch what's next. When you examine the current numbers closely, the picture grows increasingly disturbing. This isn't merely an inversion, it's profound. Deeper than 2006, more extreme than 1989, rivaling the severity last seen in 1929. In practical terms, short-term financing costs vastly exceed long-term capital costs, a distortion revealing fundamental systemic dysfunction. Banks operate on borrowed short-term funds to lend long-term. When spreads invert, profit margins evaporate. Credit contracts steadily, loan approvals slow, standards tighten. Consumers shift to credit cards for routine expenses. Nothing dramatic initially, just gradual erosion. But pressure builds within the financial infrastructure, and history shows release never comes slowly. Consider context. 1970s. Inversions preceded oil shocks, wage collapse, swift recession. The 1980s repeated it. But then, government debt was manageable, household savings substantially higher, policymakers had fiscal space for aggressive response. Today's environment is radically different. Government debt exceeds peacetime records, corporate leverage at historic peaks, household savings near zero. When the next shock materializes, and it will, intervention capacity will be severely limited. Standard rescue tools, rate cuts, quantitative easing, deficit spending now carry dangerous consequences we've never confronted. This inversion may signal more than another cycle. It could mark the end of the debt-fueled growth model defining 4 decades of global economics. Take 1989 as an instructive example. The curve inverted early that year. Markets continued climbing for 12 full months before recession finally materialized. But that downturn was relatively shallow precisely because the inversion itself had been mild. Compare that to today. Our current inversion is dramatically deeper and has persisted far longer. History demonstrates a clear relationship. The more severe the inversion, the more brutal the correction that follows. Think of it as tension in elastic. The further you stretch it, the more violent the snapback. Now return to 2006, because that case study contains essential lessons. The economy appeared robust. Real estate prices were climbing vertically. The Federal Reserve expressed confidence publicly. Unemployment sat comfortably below 5%, exactly where it is today. Yet beneath all that apparent strength, the yield curve was broadcasting danger at maximum volume. 17 months later, the global financial system nearly imploded, triggering the most severe crisis since 1929. Here's the critical insight most people miss. The time lag between inversion and recession doesn't indicate the severity will be moderate. Often the opposite proves true. Extended delays allow speculation to compound, leverage to build, excesses to multiply unchecked. That's precisely what unfolded in 1928. The curve inverted over a year before the Depression commenced. During that interim period, markets continued surging, people grew euphoric, exactly as we're witnessing now with AI hype, asset price booms, and persistent low unemployment. Then the reckoning came, and it was the most catastrophic economic collapse in recorded history. The parallels we're seeing today are genuinely unsettling. The inversion depth matches 1928 almost exactly. The timing, the widespread optimism, the collective denial that anything could go wrong, all of it aligns in a configuration we haven't observed in 95 years. Now let's address what comes next, because this is where most analysis completely misses the point. The inversion itself, that's not when the actual destruction begins. The real danger emerges when the curve starts steepening again, when short-term rates begin dropping, not because economic strength has returned, but because markets detect that something fundamental has fractured and capital starts flooding desperately into long-term safety instruments. That transition marks the official start of recession. And here's what you need to understand. That process is already underway. The curve has begun uninverting, gradually normalizing, which means the countdown to impact has quietly commenced. Think of the economy as an extended line of dominoes running from financial centers straight through to your neighborhood. The inversion represents the moment that first domino gets nudged. For a period, nothing appears to happen. All the pieces remain upright, perfectly balanced, seemingly stable. Then suddenly, without any dramatic announcement, the second piece topples, and the cascade begins. Credit availability tightens, consumer spending contracts, businesses freeze hiring plans, market psychology shifts to fear, and very quickly the chain reaction reaches a point where it cannot be reversed. That's how these cycles actually terminate, not with explosive headlines, but with quiet momentum that builds into an unstoppable force. Here's the paradox that makes this mechanism so lethal. The more robust the economy appears during the inversion period, the more severe the eventual collapse tends to be. Why? Because apparent strength generates overconfidence, and overconfidence drives excessive risk-taking. Consider 1929 had unemployment near 3% immediately before the crash. 2007 sat at 4.4%. In both cases, the prevailing narrative insisted the fundamentals are solid. Both times, that confidence was completely misplaced. The yield curve doesn't deceive. It simply signals that the ground beneath the entire structure is beginning to shift. Let's be clear about what the yield curve actually does. It doesn't create recessions, it exposes them. What it reveals is that credit flow, which functions as the absolute lifeblood of modern economies, has fundamentally reversed direction. Banks lose their ability to profit from standard lending operations. Businesses find expansion financing prohibitively expensive. Consumers begin retrenching. It's analogous to watching ocean water recede dramatically from the shoreline before a tsunami strikes. The surface appears deceptively calm right up until you recognize the water is withdrawing because something enormous is approaching from the deep. And that's precisely our current situation. Corporate debt has reached levels unprecedented in history. Government deficits are expanding exponentially. Consumers are carrying record credit card balances while simultaneously facing interest rates at multi-decade highs. The cost of capital itself has increased drastically. The entire financial system is essentially holding its breath, and the yield curve is broadcasting clearly that this equilibrium cannot hold. The longer this fundamental imbalance persists, the more violent the eventual correction becomes. When the shift arrives, it will start with subtle indicators, perhaps isolated bank failures, perhaps rising default rates in consumer lending, perhaps housing market deceleration. Then, following the exact pattern of every previous cycle, acceleration begins. Confidence fractures, equity markets collapse, and central banks scramble to implement emergency rate reductions. But by that point, systemic damage is already embedded. We've watched this pattern repeat too many times to dismiss it. The only variable that's changed is magnitude. The inversion runs deeper, the debt loads are exponentially larger, and global financial interconnection has reached levels that didn't exist in previous eras. which means when shock waves begin propagating, they'll move with unprecedented speed and strike with amplified force. Now, let's maintain perspective on something important. Financial crises, however devastating they feel in the moment, also function as systemic resets. They purge accumulated excesses. They force necessary structural adaptations. They catalyze genuine innovation. The Great Depression gave us the modern regulatory financial architecture. The 2008 collapse fundamentally restructured global banking standards. Whatever emerges from the next crisis will almost certainly transform our entire monetary framework, possibly in directions we cannot currently anticipate. The relevant question isn't whether this will unfold, but whether you're paying sufficient attention before it does. So what's the practical response? Historical evidence suggests that when the yield curve begins normalizing after prolonged deep inversion, defensive assets, particularly treasury bonds, typically outperform equities substantially. Cash regains significant value as a strategic position. For individuals, this represents a critical moment to reduce exposure to speculative debt, increase savings buffers meaningfully, and avoid yield-chasing behavior entirely. Awareness becomes your most powerful protective tool because those who recognize these signals early gain positioning time, while those who dismiss them end up absorbing the full impact. And right now, as the curve gradually shifts back toward historical norms, we're standing at precisely the same crossroads our predecessors faced in 1929. The identical quiet signal is flashing in financial markets. The identical widespread confidence pervades public sentiment. The identical voices insist categorically that everything remains fundamentally sound. But history maintains perfect memory, and so should you. The yield curve has just generated a signal unseen for 95 years, and every previous time it appeared, what followed fundamentally restructured the global economic order. So ask yourself this question directly. When the oldest, most consistently reliable indicator in financial analysis begins replicating the exact pattern that preceded every catastrophic collapse of the past century, do you genuinely believe conditions have changed enough that this time is different? Or do you prepare systematically for what history demonstrates always follows? Because if the past century has taught us anything definitive, it's that market prices can deceive, media narratives can mislead, collective optimism can blind entire populations, but the yield curve has never issued a false warning. It doesn't guess. It reveals underlying reality. And currently, its message could not possibly be more explicit. So if you found this analysis valuable, hit that like button and subscribe. Share your perspective in the comments. I want to hear how you're thinking about positioning. And remember, I'm not providing financial advice here. This is educational analysis. Your decisions and their outcomes remain entirely your responsibility.